Policy loans or policy withdrawals? Which is better and what should I use? Well, most people utilize the infinite family banking concept or the infinite banking concept of taking funds out in the form of policy loans. And here's why. When you take a policy loan, the cash value that's inside the policy builds or compounds every single year for as long as you live. So when you take a withdrawal, you're removing that cash value. When you remove that cash value, the money's no longer there, just like if you were to take a withdrawal from your 401k. Once that money is out, you lose the value the money has of earning interest. If you take money out of your checking or savings account, we take it for granted that we can no longer earn interest on something that's not there. Well, this is one of the principles that people love about banking. When you take a policy loan, those funds are still inside your policy, which means on the very first day when you start your policy, you're going to have cash value. And that very first premium payment is going to collect compound interest on your behalf for as long as you live. That's one of the huge benefits. Now, you can utilize or get your hands on those funds to pay off credit card debts or to use to make investments, like whether it's real estate or to spend for your living expenses. And how people generally do it, or most people, they take it in the form of policy loans. Now, you're still going to earn a guaranteed rate of 4% on all of that cash value that's building up in your banking system, plus dividend payments, because these are structured through a mutual insurance company that has been around for over 100 years, that has paid dividend payments on top of the compound interest guaranteed amount for over 100 years. So when we look at the amount to get you out of debt, if you're utilizing it as a debt weapon or a debt strategy to pay off credit cards or your mortgage or other loans, you're actually only being charged 5% simple interest. So if you're still earning 4% that's compounded on your behalf, and you take a policy loan and they're charging you 5% simple interest, well, that's a difference of only 1%. Most people don't have a 1% loan on their credit cards, car payment, mortgage, or whatnot. And most people know that if they can make an investment and they need to use OPM or other people's money, they know the concept that if they take a loan from a bank to make an investment, say for example, if they were investing in real estate, well, they still have a return, or they're still going to make a profit over and above what their cost of that mortgage that they took out on the property. But if you utilize the infinite banking concept and take a policy loan, you're getting a loan payment at only a 1% difference, or it's only costing you 1% for that loan. So what happens is when you pay yourself back, if you choose to, you're paying yourself back plus that 1% interest. So you're still made whole again with all of that cash value that's inside your policy. So in the short answer, most people don't take withdrawals because that stops the compounding of interest, just like it does in your checking account or in your retirement account if you remove the funds. So most people, what's in their best interest is to take a policy loan. Now, you never have to worry about leaving your spouse in debt if you have policy loans. A great example, and I have personally, in being an agent in this industry, have personally sat down at kitchen tables with hundreds and hundreds of families that are in their retirement years that had a concern because they were looking for insurance because they had long lived in the house, long paid off their mortgage. But if you live in a home for 20 or 30 years, you're probably going to need updates. The roof's probably going to need to be done at some point. You might want to update that shag carpeting that's in the living room. Or maybe you need to update the kitchens or bathrooms after 20, 30 years. So when you think about how most people utilize their debts in retirement years, what they generally do is take a home equity loan to pay for that new roof repair, for example. Well, if they pass away, that you're leaving your spouse in debt if you're using your mortgage. So what is your spouse going to do if you have a home equity line and he or she can't afford the payments? They're going to repossess that house. Or you're going to put your spouse in a situation where he or she has to sell the home that you've lived in right after they've lost their spouse. Well, when you have your loans in your banking policy, when you pass away, all of those policy loans will be paid off with the death benefit. You're going to see that the death benefit is always higher than the cash value. So any outstanding loans won't leave a burden to your spouse because they're going to have more tax-free money in the form of a death benefit over and above wiping out all that debt. Stop right there. If you're only watching this because you're bored and you have no intentions of implementing this or taking action, then the rest of this video is definitely not for you. However, if you are someone that's interested in taking action and having somebody that has experience creating custom programs specifically to fit your needs with where you are today without utilizing any other funds other than what's in your budget currently, then click the link in the description below. There you'll have a link to my calendar where I'll be able to have a 30-minute consultation with you and gather additional information to show you how the infinite banking concept and having a family banking system could benefit you and your family. If you're a licensed real estate agent and you're looking for an agency that you can create banking programs with and want to have a mentor that you can work side by side to learn the ropes, click the link in the description below. There you'll have access to my calendar, and on my calendar, you'll be able to schedule a 30-minute consultation. Just put in the notes, looking for full-time or part-time work. If you don't have your insurance license, but you're still interested in seeing how you could work part-time through the comforts of your own home, sharing my video with other people, schedule a 30-minute consultation. The way it stands today, how many people do you know wish they had additional emergency funds set up so they could access them in times of emergencies? How many people do you know have student loan debt? How many people do you know have children that are either in college or just got out of college and they're looking at their own personal economy and what's it going to take to actually retire comfortably? Don't forget to like, subscribe, and ring the bell so that way you'll be notified whenever I post new videos. Thanks a lot and have a blessed day.